Now, back by popular demand, it's the Lance Roberts Show.
And good morning at 6:06 as we get ready to kick off this Monday's edition of the Lance Roberts Show. Man, a lot of stuff going on this weekend we've got to get into today. Headlines, of course, driving the markets this morning as we kind of get up and kind of get going for the week. Markets are pointing higher this morning. Dow up about 120 points. The S&P is looking to point higher about 12 points this morning. Now, that's going to push the markets right up into this very important kind of resistance level that is both kind of psychological in nature. It's the kind of 2,800 level, so 2,800 on the S&P 500, just kind of this big round number. It tends to be psychological. But more importantly, this is where the markets really struggled in September and October of last year, putting in several tops right at this level, a little bit higher than 2,800, maybe around 2,810-ish altogether. But today we're going to be pushing into that. So interestingly enough, though, the expectation for an extension of the trade line of the trade talks was already well expected. In fact, this was the news last week that was really driving the markets. Progress on trade, of course, comments from the Federal Reserve that they're going to become much more easy in terms of their monetary policy. In other words, they're not going to be raising interest rates as fast. They're talking about potentially stopping the reduction of their balance sheet. And which is interesting considering that we're in the middle of an economic expansion. Employment growth tends to be strong here. And, we're now stopping reduction of the balance sheets because the market had a little wobble last year. Has to, and again, just as we were listening a few minutes ago to the top of the hour headlines, economists are starting to predict a recession within the next year to 2 years, which may be a little bit long in nature. There's lots of current evidence the economy is slowing actually a lot faster than that. But the question becomes that if the Fed stops kind of reloading their guns, so to speak, and using some Texas terms here, the issue is will they be prepared to face the next recession? We're running $1 trillion deficit in the government right now at a time when the economy is growing. The Federal Reserve is stopping reducing their balance sheet at a time where their balance sheet is more than $4 trillion in size, up more than 400% from its lows that we saw prior to 2009. And of course, interest rates have barely risen. We're up about 2.25% on the Fed funds rate, but the 10-year Treasury rate is basically running at levels that we've been at for the last several years. So, we haven't really reset the table so much in order to combat another downturn in the markets or in the economy in the course of the next few years. So this has to lead to some questions here about the efficacy of policy at this point and potentially what happens if things continue to weaken as they have been as of late. But we're going to talk about that this morning. I thought another kind of big news headline over the weekend was Warren Buffett. Of course, Buffett had their annual shareholders meeting, and comes at a time right where, you're preparing for your meeting, everything is fine, you're getting everything put together, and like a few days right before your meeting, one of your largest investments declares a massive write-off, $25 billion, right down the tubes. Now, for a company the size of Berkshire Hathaway, $25 billion, it's a bruise, right? It's a bit of a bloody scratch. So you throw a Band-Aid on it momentarily, but it's more symptomatic of what is now occurring within the overall markets. What happened with Kraft Heinz is something that we've seen and will see more of as we go forward. So we'll talk a little bit about that today, what that kind of means. But also, too, one of the misconceptions about Warren Buffett, one of the most admired investors in the world today, is that Warren Buffett just buys stuff and never sells it, right? He just sits on it forever. He is a very long-term investor, that's true. But as we're finding out now, even he is addressing the issue that there's some, if his portfolio is a forest of trees, a few of his trees have diseases. So the question is what do you do with them? And of course, Warren Buffett isn't a guy that just simply buys stuff, sits on it, and holds it. He actually does manage the companies that he owns. But more importantly, he does sell them when that value is no longer there. And it'll be interesting to see what he does now with Kraft Heinz after this recent revelation in terms of the company and what happened. And again, we'll talk some more about this. But does this lead to a breakup of the company? They begin to sell off assets, divisions of the companies? Do they break it up, streamline it? This right here is a key issue of why Warren Buffett is an investor, and you and I and everybody else in the world that invests in stocks or mutual funds or ETFs are just speculators. We're just kind of hoping the price of it goes up. We buy it and we just kind of hope it goes up over time, and that works out well. But Warren Buffett's, and we've talked about this before, Warren Buffett's a very different investor, because when you own a very substantial chunk of the company, or you own all of the company, when you run into a problem like this, and with, like, as an example with Kraft Heinz, is all of a sudden you make decisions and you say, well, okay, this isn't working like I thought it was, so let's see if we can unlock some value. We're going to sell off this division. We're going to merge this division with this company over here. We're going to create some partnerships, and we're going to do some more marketing and advertising, whatever it is. But you begin to actually change the dynamic and the trajectory of the company. That is a far different way to invest in a company than just buying something and hoping it goes up in price. And this is why, as investors, you and I and everybody else, our 401k plans, our IRAs, our SEP IRAs, the most we're hoping for is that we can buy stuff and it goes up over time. And this is why on the show we talk about, managing risk, understanding expectations, how to avoid major losses in your portfolios over time, because that's the hard part of getting back. Getting back to even is fine in terms of your investment portfolio, but the problem is that you lose all the time getting there. So if you lose half your money and then eventually get it back, great, you haven't made any money, but you have irreparably lost the time getting back to even. And unfortunately, unless you've contracted vampirism, over the weekend from watching too much Twilight, then, you're not going to make it. And you may have contracted gayness along the way. I'm not sure. So anyway, we'll be right back. Got some stories to get into this morning. Don't go away. You're listening to the Lance Roberts Show right here on the Voice of Texas.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.